You're tuned into the #1 source for cryptocurrency information. We're here to provide the latest updates as they happen. Today, we're diving deep into the world of Bitcoin, exploring its importance and why it deserves a place in every investor's portfolio. From its potential to hit $100,000 by 2024 to the imminent arrival of Bitcoin ETFs, there's a lot to cover. We'll also unpack the changing stances on Bitcoin and its impact on the global economy. Stay tuned for the latest Bitcoin news and don't forget to hit the like and subscribe button to never miss an update. Let's dive into the future of Bitcoin, an asset that is making waves in the investment world. Bitcoin's potential seems to be recognized universally, and it's not just everyday enthusiasts who are taking notice. Major financial institutions are also boarding the Bitcoin train. Standard Chartered Bank, for instance, has reiterated its forecast that Bitcoin will reach a staggering $100,000 by the end of 2024. This forecast is not just a shot in the dark. There are concrete factors that could pave the way for this massive price increase. One of these is the anticipated approval of several US-based spot Bitcoin exchange-traded funds, or ETFs, in the first quarter of 2024. These ETFs could open the floodgates for institutional investment in Bitcoin, which could be a significant driver of price growth. Another factor that could contribute to Bitcoin's price increase is the next Bitcoin halving. For those unfamiliar with the term, halving refers to a reduction in the reward given to Bitcoin miners for verifying transactions. This event, expected to take place in late April 2024, decreases the rate at which new Bitcoins are created, thereby limiting the supply and potentially driving up the price. In addition to these factors, Bitcoin's dominance in the overall digital assets market cap has increased to 50% from 45% in April. This dominance could further drive investor interest and push the price of Bitcoin even higher. With all these factors in play, there is a chance, albeit a speculative one, that Bitcoin could reach the $100,000 mark before the end of this year. Given these promising forecasts, it's easy to see why Bitcoin should be on every investor's radar. Even seasoned financial experts are shifting their views on Bitcoin. Let's take Jim Cramer, for example. Known to many as the host of CNBC's Mad Money, he's recently been encouraging investors to reconsider their positions as the cryptocurrency reaches its highest value in a year and a half. Indeed, Bitcoin has surged past the $38,000 mark. This positive momentum is largely attributed to industry optimism surrounding the potential approval of a spot Bitcoin exchange-traded fund, or ETF, by the US Securities and Exchange Commission. Now, Cramer's changing stance has faced some criticism. There are those who suggest that going against his advice could be a prudent financial strategy. But isn't that the beauty of the investment world? A multitude of opinions, a multitude of strategies, all coexisting and competing. Of course, it's not just about the voices of individual experts. We're seeing a broader shift in the financial world. Institutions that once viewed Bitcoin with skepticism are now embracing it. And it's these changing attitudes that are a testament to Bitcoin's growing influence. With Bitcoin's value on the rise and the potential approval of a Bitcoin ETF on the horizon, it's clear that the world of finance is beginning to see Bitcoin in a new light. It's not just a volatile asset or a speculative bubble, but a legitimate part of the financial landscape. And as we continue to follow these developments, we'll see just how far this shift in perception will go. Bitcoin's potential impact extends beyond individual portfolios and into the global economy. As we navigate the ever-evolving financial landscape, it's important to consider how Bitcoin interacts with and influences global economic trends. Take, for instance, the perspective of Arthur Hayes, co-founder of BitMEX, who believes that China may soon flood its economy with credit. This massive influx of capital, he suggests, could significantly strengthen the yuan. But what does this mean for Bitcoin? Well, Hayes posits that this could support the prices of risk assets, including Bitcoin. China's potential credit surge isn't the only factor to consider. Hayes also predicts a decrease in global demand for dollar credit. As this happens, the price of fixed supply assets like Bitcoin and gold could rise. This is an intriguing forecast, especially considering Hayes' decision to focus on crypto investments over US Treasury bills. So what do these scenarios tell us? They underline the fact that Bitcoin's value isn't isolated. It's influenced by, and in turn, influences global economic movements. This is a far cry from the early days of Bitcoin when it was often viewed as an obscure fringe investment. Today, it's a player on the global stage, intertwined with economies across the world. This increasing integration of Bitcoin into the global economy underscores its importance in any investor's portfolio. As Bitcoin becomes more embedded in economic trends, its role as a risk asset and a potential hedge against traditional financial systems becomes more apparent. In conclusion, as Bitcoin becomes more intertwined with global economic movements, its importance in an investment portfolio is only set to increase. Its potential to benefit from global economic shifts, like the ones predicted by Arthur Hayes, makes it an asset that's hard to ignore. And as we move forward, keeping a close eye on these trends will be key to understanding Bitcoin's trajectory. One of the most anticipated events in the Bitcoin world is the arrival of Bitcoin ETFs. This development has the potential to reshape the landscape of cryptocurrency investing, and it's happening sooner than you might think. Grayscale, a titan in the crypto industry, is at the forefront of this movement. The company is seeking to launch the first Bitcoin ETF through an uplist, a strategic maneuver that could see its ETF hit the market faster than those of its competitors. This move is not just about beating the competition to the punch, but it's also a testament to the proactive and innovative spirit that drives the cryptocurrency industry. The introduction of a Bitcoin ETF could have significant implications for current shareholders of Grayscale's Bitcoin Trust, or GBTC. While some may perceive this as an opportunity to diversify their holdings, others may see it as a reason to exit the Bitcoin market altogether. This is a complex situation, and each investor must carefully consider their own circumstances and investment goals. However, it's important to remember that the advent of Bitcoin ETFs is about more than just Grayscale. It's about the broader acceptance and legitimization of Bitcoin as an asset class. The approval of Bitcoin ETFs by regulatory bodies signals a shift in perception and shows that Bitcoin is being taken seriously in the world of traditional finance. Bitcoin ETFs also open the door for more institutional investment in Bitcoin. This could bring increased liquidity and stability to the Bitcoin market, making it an even more attractive investment opportunity. The arrival of Bitcoin ETFs could be a catalyst for further growth and mainstream adoption of Bitcoin. This is a pivotal moment in the evolution of Bitcoin. It signifies a synthesis of the innovative, decentralized world of cryptocurrency and the established, regulated world of traditional finance. This is a testament to Bitcoin's resilience, adaptability, and enduring value. The arrival of Bitcoin ETFs is a game changer, and it's one more reason why Bitcoin deserves a place in every investor's portfolio. So, why should Bitcoin be a part of every investor's portfolio? Firstly, the potential for high returns. Bitcoin, as the pioneer and most dominant cryptocurrency, has shown remarkable growth over the years. It's not uncommon to hear of the extraordinary profits made from early investments in Bitcoin. While the market has its ups and downs, the general trajectory has been upward, making Bitcoin a potentially lucrative investment. Secondly, Bitcoin supports future technology. It's more than just a digital currency, it's a technology. The blockchain technology that underpins Bitcoin has the potential to revolutionize a multitude of industries by removing intermediaries and enabling new economic activity. By investing in Bitcoin, you're not just betting on a digital coin, you're backing a transformative technology. Thirdly, Bitcoin offers resistance to inflation and government interference. Unlike traditional currencies, which are subject to government control and can be devalued through inflation, Bitcoin operates on a decentralized network. It has a limited supply, mimicking commodities like gold. This makes it a potential hedge against inflation and a way to diversify your portfolio. However, as with any investment, there are risks. The Bitcoin market is volatile and can be influenced by a variety of factors. It's important for potential investors to understand this volatility and be prepared for fluctuations in value. This is not a deterrent, but rather a call for informed investing. Careful research, understanding market trends, and perhaps most importantly, investing only what you can afford to lose are key strategies for navigating the Bitcoin market. Bitcoin's potential for high returns and its resistance to inflation make it a valuable addition to any portfolio. As we've seen, Bitcoin's potential makes it a must-have in every investor's portfolio. From its positive future prospects to the shifting perspectives among financial pundits, Bitcoin continues to solidify its place in the global economy. The anticipated arrival of Bitcoin ETFs and its inherent investment benefits further underscore its importance. So whether you're a seasoned investor or just starting out, the value of Bitcoin in a diversified portfolio is undeniable. Remember to hit the like button if you found this video helpful and subscribe for more updates on cryptocurrency. Stay savvy, investors.